If you've been following Canadian real estate lately, you've probably heard the same story on repeat. High interest rates, cautious tenants, softening rents, and market slowdowns. Hi everyone, and welcome back to my channel. I'm the digital avatar of Dean Aronovici, taking the wheel while Dean does what he does best: negotiating top-tier commercial leases across the Greater Toronto Area. With over a decade of hands-on experience across industrial, retail, and office properties, Dean knows exactly what it takes to protect your bottom line. If you're an investor looking to secure or scale your commercial footprint, this update is for you. Let's dive in. Across most of the Greater Toronto Area, or GTA, the industrial market has been taking a breather. Rents GTA-wide dropped to around $16.3 per square foot. Except, if you look just a few miles north, something completely wild is happening. While the rest of the region is cooling down, the GTA North, we're talking Vaughan, Markham, Richmond Hill, Aurora, and Newmarket, just completely decoupled from the rest of the market. In the second quarter of 2026 alone, leasing activity up north shot up by a massive 44.4%. Over 2 million square feet was scooped up in just 3 months. So why are global giants like Tesla and LG racing to drop millions on industrial space in the north while the rest of the market is slowing down? Let's break down the data, the massive mega leases, and the brand new playbook shaping real estate right now. Let's start with the numbers. In industrial real estate, net rent is what tenants pay purely for the space. As we wrapped up the first half of 2026, the GTA-wide average net rent slipped to $16.3 per square foot. Meanwhile, GTA North shattered records, climbing to $17.34 per square foot. When you add in taxes, maintenance, and insurance, occupiers in the North are paying an 8.2% premium compared to the rest of the GTA. The North gives companies direct access to major transit arteries, like highways 400 and 404. Plus, York Region sits on a massive pool of highly skilled tech and manufacturing labor. Top talent attracts top companies, and those companies demand state-of-the-art facilities. It's an upward spiral that's making northern real estate the most prized industrial footprint in Canada. Now, it's one thing to look at overall data, but look at who is actually signing these checks. First up, Tesla Motors Canada. They signed a giant 287,000 square foot lease at 175 Hillmount Road in Markham. That alone was the 6th largest industrial lease in the entire GTA this quarter. But the even bigger story is unfolding even further north. In King City, an area just outside the traditional core markets, LG pre-leased a mind-boggling 1 million square feet at the King Jane Business Park. Think about that. A nearly 1 million square foot commitment. It proves that major multinational corporations aren't just looking for traditional spots in Vaughan or Markham anymore. They are literally expanding the borders of what's considered prime real estate, just to get their hands on new, high-tech space. Now, if you glance at the surface stats, you might notice something confusing. The regional vacancy rate actually ticked up slightly from 4.3% to 4.5%. In a normal market, higher vacancy means lower demand, but real estate strategists call this the vacancy paradox. Vacancy didn't rise because companies are leaving. It rose because developers finally delivered over 1 million square feet of brand new supply. Look at Vaughan. Developers built over 680,000 square feet of new space, and the market absorbed almost half of it immediately, keeping vacancy basically flat at 3.8%. The market is eating up space almost as fast as it can be built. And what they are building matters. We have officially entered the era of specification over location. Modern tenants aren't just buying square footage on the floor. They are buying cubic volume. The new gold standard is 40-foot clear heights. High ceilings allow companies to install massive automated robotics and advanced vertical racking systems. If a building has 40-foot ceilings, tenants are happily paying $18 plus per square foot. No discounts allowed. If a building is older and lower, it gets left behind. That said, it isn't an easy win for everyone. Local dynamics still matter, and Aurora is a great reality check. In Aurora, vacancy spiked to 6.6%, largely driven by subleases. One deal at 125 Engelhard Drive took a massive 749 days to close. Why? Because when a market gets flooded with sublease options, tenants take their time, and negotiations get complex. Even in a hot overall market, secondary or sublease space requires real strategy and patience. So, what's the takeaway as we look past mid-2026? Institutional giants like Brookfield and JP Morgan are pouring capital into these northern corridors because the fundamental rule of industrial real estate has changed. The GTA North didn't just survive the slump, it rewrote the playbook. The lesson for developers and investors is crystal clear. If you build modern, 40-foot clear height inventory, the world's biggest companies will line up to rent it. What do you think? Would you invest in 40-foot warehouses, or is this industrial surge bound to cool down eventually? Let me know in the comments below. If you want to navigate this unique market, align your real estate with your business goals, and structure a deal that maximizes your net effective savings, reach out to me. Call the number on your screen or book a free consultation on the link in the description below. Don't forget to like, subscribe, and hit that notification bell for more deep dives into real estate and market trends. Thanks for watching, and we'll see you in the next market update.